So as you heard, we are talking with Gemma Dale from nabtrade. What's your role at nabtrade?
So my title is Director SMSF and Investor Behaviour, but I basically do investing insights and education, and I also get to look at our customer data and look at investor behaviour, which is super fun and super interesting. And then talk about it.
Yeah, and Gemma's been on the podcast over the years, so if you're a regular, you would know of her. And nabtrade has not paid any money for this. So it's just a community service thing, but hey, if they want to give me money, we'll take it. But so are Gen Zs, do you think they're actually better investors, or are they more active type traders? What's the data that you're seeing at nabtrade?
So the data that we have, first of all, better investors is always a really difficult question. I think it's really important, and you will know this because like me, when you started, the simpler, easier products were sort of less accessible. What we see from older investors is they've got quite complex portfolios because they bought some CBA in the float, and then they bought some BHP because you had to buy BHP, and then they went, oh, CSL looks like a growth company.
Got some T2 in there as well.
Yeah. Oh, yeah, they've definitely got that. So they've got these really interesting, complex portfolios, and if they're very astute and have made good decisions over time, then they will be a little bit more like what you would see if you went to see an advisor and got professional advice. And if you just let stuff run, it can be all over the show. So you can have some really interesting things. What you see with young people is they have these really, really clean portfolios. Part of that is a function of timing, right? So they come to market, and that first decision they make is to become an investor. It's the most important decision you'll make. I'm going to be an investor. That's what I'm going to do. And then the second thing they do is go, what am I going to buy? And in our data, what we see is that is the ASX 200 ETF, Daylight, the S&P 500 ETF, a couple of other things, Daylight, and then other stuff. Like, it's absolutely extraordinary how consistent the behavior is. People have bought the story about ETFs and just getting diversified market exposure for a really good price, and that's their strategy.
Is VAS the biggest holding in terms of ETF?
By an enormous margin. Enormous. Yeah. The brand is out there. People trust it, they know it, and that's what they buy. And so we see that, and then we see them buying consistently. I think what I love most about our data is we tend to tell people to do an auto invest type concept, right? We're just going to take it out of your account every Wednesday. We're going to buy some, or every fortnight when you get paid, or whatever it is. What we see, though, is that even though they're doing it consistently, they will buy more often. They will buy more, and more people will buy. That sounds like I'm saying the same thing, but it's not. It's three separate cuts of the data when the market falls by more than 1% on a single day. So what we're seeing is strategy is very simple. I'm going to buy the ASX 200 or the S&P 500, maybe the NASDAQ, but I'm going to do it when it's a little bit cheaper. And that's when I would prefer to buy. And I might do $500 a month or $1,000 a month, but I want to put my $1,000 to work when the market's off more than 1% rather than a day when it's up. I love that. I think it's amazing.
Do you, and at the risk of being that old annoying guy, anyone under probably 35 hasn't lived through an actual long-term financial crisis.
Mm-hmm.
Is there some rude shocks coming in? Because I just want to kind of pivot maybe and talk, if you've got many investors on nabtrade that look at leverage stuff or thematic stuff. Like, do you see that much? Because there's going to be a lot of people, getting a big spanking at some point because they haven't lived through a prolonged downturn.
Mm.
And, for me personally, my investment portfolio is not 100% growth. I won't do more than 85, 90. But you see it online all the time. Yeah, I'm geared ETFs. I'm going to town, baby, because it's always been good, right? And when there has been a V or a hockey stick, we got out of that. Sweet, let's keep going, baby. So Are you seeing much from the leveraged ETFs or thematic stuff?
Yeah, that's such a good question. I think so. There's a couple of things. One is half of our investor base has joined us either during or post-COVID. So it gives you an idea of how lengthy people's investing experience has been. Worth noting, some of those people might have invested in the past and then sort of reactivated their account when they saw a buying opportunity, that kind of stuff. But let's say half of our base is new investors and their investing experience has been COVID and post-COVID. That very sharp and a downturn and aggressive rebound. And then Liberation Day, which, barely even shows up on a chart within 6 months now. It was so short. I think there's a couple of things to consider. One is, so we absolutely do see some of the more aggressive stuff, but we see really small proportions of it. There's little cohorts of people who'll be very, very active and very aggressive in their trading. People who are day traders and all of those sorts of things. We don't see a lot of it. Now, that might be selection bias. nabtrade's owned by a bank. We don't have, if you want to do options trading, you've got to do a little course and you've got to do all the things. You've got to, it's not the kind of platform you're going to go to if you are a super high risk trader and you're looking for very, very, very high volatility opportunities, right? So there's a different set of platforms for those people. And so we tend to see less of it, I think, than might exist in the world. Certainly less than in the US. I don't know how much you've been following what's happening in the US, but there's a lot of wild stuff.
Yeah,
zero day to expiry kind of options. This sort of thing is very, very hot. We don't see much of that at all. It tends to be quarantined to a really small number of people. What we do see in our base is the vast majority of people who are younger in these really vanilla products. So as I said, it's daylight between VAS and the next product. And then daylight between the next type of ETF and what comes after it. So they're really small, those sorts of things. I think it is entirely possible people will have a rough experience when there's a market downturn. It happens, but it won't be because of leverage in our younger population.
So this, I guess, recent tranche of research that you guys have done, what type of questions were you asking?
This is not questions. And this is what I love most about my job. This is not questions. This is not an opinion
just
survey.
Observing the data.
This is just the data. And I love this because we get opinion surveys all the time pitched to us. I'm sure you do too, going, what would you do? And as you know, when you were an advisor, you can do a risk profile with someone and go, what are you going to do when your market, when your portfolio falls by 20%? People are like, I'm going to buy more. And then the time comes and they're like, I'm out. You're like, oh, that was not what we agreed. So this is the data. This is what people actually do. And what we have seen is that younger investors are following exactly the strategy I mentioned. When the market falls by more than 1%, we see a significant, statistically significant and sort of very obvious uplift in the data of more people buying. Those people who are buying more and they will buy more often. So if it's someone who will ordinarily place a trade once a month, they will buy 3 times if the market is off more than 1% in that month when the market falls by more than 1%. And then we see sort of a shrinkage on the other side. When the market is up, they tend to pull back a little bit. They're less aggressive. They're not wanting to chase. They're just very happy to buy the dip wherever possible. But I think in a dollar cost averaging strategy, that makes so much sense, right?
Yeah. And it's kind of funny because, if you dollar cost average and you've got your monthly or weekly amount, it's kind of, if the market does drop 1% and you decide, because when the Fantafura had his tariff issue and the
big reveal,
the big drop in the market, you could hear a beeping in my office, and that was me backing up the truck and tipping cash into the
Just
market.
Throwing it in. Yeah. And that's what I was doing too.
However, it's like, well, you are kind of timing the market, Glenn, and we say don't time the market, but there is still an underlying DCA throughout the year and a bit of an opportunity fund.
Yes.
Because I don't think it's too bad to catch a falling knife and if you're not familiar with that investing term, quote unquote, everyone, it's, there could be a share price at $100 and it drops to 80 and you're like, I'm putting $1,000 in, you put $1,000 in and it drops to 70 and you're like, oh, I'm putting another $1,000 in, and you kind of, that's all good if it's a long-term hold.
Mm-hmm. If it's a high-quality opportunity.
That's right. Like I'll catch a falling knife all day long if I'm buying for the long term.
You're willing to wear the cuts and the bloody hands.
Yeah. When you're day trading, it could be an issue. And I think, it kind of is timing the market, but you're really not, because you're not doing it on a monthly or weekly basis. You're just taking some opportunity. And all that to say, I was going to ask you, do you have in your data when someone signs up to nabtrade, they would have their age, right? So you can get these
absolutely.
cohorts.
So you have to be over the age of 18. You were talking about GenZ.
Yes.
So the under 18s, we don't see them because you have to be 18 to have an investment account.
Do you ask what people's nominal income range is?
No. So we just get the data that's required for you to open an account. We don't get any other personal details, and the cash account attached to the platform is your trading account. So we don't see your salary. I mean, you'd be an unusual person getting your salary paid into it. It's in the trading account.
Could. It's just
good luck to you. Please do. But that's, you can have a lot.
I think
it's not like there's a debit card attached to it, right? That's your trading account. So
the only reason I asked was because, it's tight out there. But if we're saying, you're saying here, if the market drops by 1%, our youngest investors, they go bigger. Each trade is 5% larger than normal.
Yeah.
So there is still people that have spare cash relative to their situation.
Yeah, absolutely. And they are, this is what I love about it. So the catch a falling knife concept is super important if you're a direct share investor. And there have been so many examples of companies that people felt were, the one at the moment is CSL, right? It's at $310 and then it was sub 200. And we had investors buying it all the way down. Now, CSL is still a really high quality company, but did it bottom out in the 170s? I don't know. And so we've had people buying it all the way down and then going, this is just depressing. And then plenty of other examples, Domino's Pizza, lots of them, right, where the company was a high growth stock, it was going really well, it takes a dip, people go, oh, I love this company, it's great, I'm going to buy this dip, and then it just keeps dipping. When it's an ETF, and this is what we're talking to, is mostly ETFs, different story, right? You've got 200 companies in that portfolio, just in that single investment. You will hopefully not have the dominoes experience where it just keeps falling and falling and falling and falling. It happened during the GFC, but that was supposed to be a once-in-a-lifetime experience. And COVID was, as I said, it was 30% in 3 weeks. And that was a once-in-a-lifetime experience, I hope. Let's never have another pandemic.
Like all these 1,000-year floods in New South Wales that happened 3 years running, we
might have another pandemic. That'd be super depressing. Nobody wants another one of those. And there was a reason why the market fell so aggressively. The entire global economy locked up. No one had any idea how it was going to play out. And then it just turned and ran. So if you were buying ETFs during that period, you were buying a whole basket of companies, that idiosyncratic, stock-specific, company-specific risk that you have when you are buying individual companies, and where the falling knife thing is a bigger issue. Just doesn't feel as relevant in this scenario. If you're building a portfolio that's already naturally diversified because it's ETFs, you're building for the long term, and you're building something boring and sensible that, the whole economy has to go to pieces for your ETF to be worth nothing, right?
Yeah. Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.